Hello, I'm Mallie Schatzfeld, Managing Editor of Orthodontic Practice US, Endodontic Practice US, and Implant Practice US, Medmark Publications. Welcome to a live presentation and question and answer with Shaylin Peck. In our webinar today, we'll be exploring proactive tax-saving strategies for your dental practice, including how warranting your work can help reduce your taxable income. Before we get started, I'd like to invite viewers to use the question box in your control panel to ask any questions, and your questions will be answered at the end of the session. Also associated with the presentation is a free CE quiz. At the end of the webinar, we will email all attendees instructions on how to access the CE quiz. I'm pleased to introduce our guest for today, Shaylin Peck, an independent consultant who has worked in tax planning and strategic implementation over 20 years. After graduating from Utah State University with a bachelor's in accounting and a master's in accounting taxation, Shaylin went to work for one of the big four accounting firms. He spent some time in a boutique tax practice and then grew his own CPA practice over the next 16 years. His expertise is in entrepreneurial ventures, strategic entity structuring, and tax planning. He was one of the original founders of Dental Intelligence and has helped his own and clients' businesses grow over the past 20 years. After selling off his CPA practice and successfully transitioning out of Dental Intelligence, Shaylin spends his time consulting and developing his own business holdings. Shaylin, we turn the webinar over to you to learn more about our topic for today.
Mallie, thank you so much. Excited to be here. Today I want to share with you the things that I learned in taking my business from zero to where we got it to when we sold. We're going to talk about some great tax strategies that you may or may not be taking advantage of, and all the learnings that I had in working with other clients on what to do and what not to do. One time when I was hiking in the Grand Canyon, I went down there with my dad and some friends. And we had this big group of people, and we had a lot of people who were unprepared to do it. By the time we got down to the bottom, we'd had to cut out a lot of the ends of shoes so that the people would stop ramming their toenails into too short of shoes, and they were actually losing their toenails. Then we had cramping. We had people get hypothermia because they were underdressed for it. We had heat exhaustion later in the day. And it's a 25-mile hike to go down from the top to the bottom, across and over and back up. And we were seeing a lot of problems along the way. We were also dealing with blisters, fatigue, and things that could have been taken care of with a lot better preparation. Just as preparation is needed for a successful hike of the Grand Canyon, so is preparation needed in running your own business. Lots of it. Here's what I know about you guys watching this today is that you are trained professionals. What you may not know is your technical skills are only about 7% of what it takes to run a successful business. What you didn't learn in school is the other 93% that is needed. Now, stepping out and running your own business is not an easy thing. In fact, I remember one time hiking down in the Grand Canyon, I was there with a bunch of young men, and the young men wanted to jump off of some waterfalls. Well, they took me up to the top of a 35-foot waterfall, and they expected me to jump off of it. I hate heights. And there I am, standing up there for what seems like an eternity, and finally I take that first step, and it was all downhill from there. Sometimes taking that first step is the hardest thing that we do. Your first step was done when you learned what you needed to do for that 7% in school. What are you doing about the other 93%? The secret to the other 93% is asking the right questions. What a client needs from his CPA is that the CPA asks the right questions. So if a CPA asks the right questions, he'll have the information needed to help you solve your problems and help put you in the best financial position possible. So what I'm going to talk about is some of the questions that have come up in my client meetings. In fact, I've had client meetings where I've left them and the client says, you know more about me in an hour than my CPA knew about me in the 10 years working with them. So one of the questions that I always want to know is, what are your goals? Where do you want to take this? Where do you see yourself going in 5 years? Or where do you see yourself 5 years from now? What's the exit strategy? These are questions that I ask all the time, and I want to know the answer so that I know how to help. Here is a question that I always ask, and often am surprised at the answer. Are you paying too much in taxes? In asking these questions, I've been able to find a bunch of tax strategies that weren't being implemented. What is it that you need help with? Do you need to plug in the right consultant, find a proactive CPA firm that will bring ideas to you, outsource bookkeeping, plug in analytics software that gives you leading indicators to make changes for the better? The answers always lie in the right questions. For example, last year I had a friend come to me who was really struggling in his business. He'd started a new business and he'd gone out and bought all the shiny new equipment that the salespeople brought to him. And he was in trouble. Add to that COVID hit and the business was going nowhere quickly. So I dove in, started asking questions, and found out that he needed to know what his break-even point was, that he needed an SEO specialist, and that he needed an outside consultant plugged in. I got all these things arranged, figured out that his break-even point was $45,000 per month. Well, this was a big obstacle for him because the month after we hired the consultant, he was at $14,000. It looked like it was a hopeless thing and going nowhere quickly. Well, here we are about 8 months later, and he's well over $100,000 a month because we fixed the problems by asking the right questions. His W-2 income, that probably won't last long because he is a sports professional, will eventually run out, and this income can be replaced with the assets that he is building. To sum up the rentals, if you want to take a deduction against your ordinary income, you need to provide more services than you would if you were renting your properties out long term. This allows you to take those losses. So in asking the right questions, I've found that some of my clients have appreciated assets in their portfolio, such as appreciated stock that their investment broker manages. One of the ways to double dip in the tax law is to take these appreciated stocks and donate them to a 501c3 or a charitable organization. If you do that, you don't have to recognize the gain and you get to take the deduction. This is the only thing in the tax code that I have seen that allows you to double dip like this. For example, I had a client who sold a business last year and they wanted to donate a bunch of stock to charity. By donating the stock directly to the charitable organization, they didn't have to recognize the gain and they took the deduction for the donation that they gave, and they were able to save $300,000 in taxes. Another question that's come about is, I'm ready to sell my home, and how is this going to affect me tax-wise? Well, the great thing is the law allows you to sell your home, and if you're married, not recognize the first $500,000 of gain, $250,000 if you're single, on the appreciation of your property since the time you bought it. So to be able to do this, you've got to live in the property and own the property 2 of the last 5 years. I have a client who's done this 4 times, and they've saved $450,000 in taxes by just selling their home and moving it into the next one. And they've saved $450,000 in taxes by just making sure that they were within the bounds of how the law was set up. First, you need to own the home for 2 of the last 5 years and live in it for 2 of the last 5 years. So if you move out of the home, you've got 3 years to sell it from the time you move out and own it to be able to take advantage of this law. So another thing that's come out in the questions is whether a client is providing a warranty for their product and service. Most businesses offer a warranty. Most businesses offer some sort of guarantee or warranty when they sell something. Many times in my CPA practice, When the client wasn't satisfied, I just wrote off the bill, taking it out of my own pocket. There are a few ways of dealing with warranties in your business. The first way is you can do like I did, just take it out of your pocket. Another way is you can charge the client for this warranty, such as when you go to Best Buy or other places and you buy a piece of furniture, they're always going to ask you if you want the extended warranty on the product. There are a few ways to do this. First, self-insure, and if something goes wrong, you as the company or owner takes the money out of your pocket and makes it right. Second, you can sell a warranty to the client and take that money into income and be taxed at your current rates. Or the best way to set up a warranty plan is setting up a plan that allows you to write off the calculated exposure and have the ability to cover any issues that may arise. This third option can be done using pre-tax dollars, and this program can work for products or services. So one of my clients sells a lot of trucks, and he offers warranties on them. He offers a free 30-day warranty that he takes care of, and he sells an extended warranty for the vehicles. He was taking this money and he was putting it into his income and not taking a deduction for it until there was a problem that came about. We implemented this strategy for him, and in his first year saved over $150,000 by setting up a plan that allowed him to write it off. This plan is set up by our sponsor, Strategic Risk Alternatives. They set up an accountable plan that is fully allowed by the IRS, where they take and calculate the risks that you have associated with your warranties, and this allows you to set aside the money tax-free to wait for any losses that may occur. So the IRS code section that allows us to do this is the same as captive insurance companies. The code section is 831B of the Internal Revenue Code. And 831B allows us to self-insure, and we can self-insure over a lot of different things. And one of those areas that we can do this is through our warranty programs that we offer as business owners. So the one thing that you do need to know is you have to set this up under an accountable plan. If you try to set this up on your own and just do it, the IRS would just consider that income, and you would pay all the penalties and interest associated with doing so. Another area that has come to light in asking the right questions is whether or not there's enough insurance bought. In talking with my brother, who's an attorney who's both sued insurance companies and defended insurance companies, he says one of the biggest risks to owning your own business is the lack of insurance that you have. Under Code Section 831B again, it allows us to set up our own insurance company to insure the risk that we're typically not insuring otherwise. Many times these are balance sheet items that we forget to look at when talking with our insurance agents. Some examples of these types of risks are the downturn in the economy, government risk, audit risk. If you set up a captive insurance company, you take money from your business and you take it as a deduction for the insurance that you need into your insurance company. While you're doing this, your business gets a deduction and you don't have to pick up the money that you put into the insurance company as income. So the money then sits inside the insurance company and it waits for claims. If you have a claim come along, which is the first line that this insurance money is for, then you just take it out of your insurance company and you're made whole. The money can be invested while it's in there, in liquid investments the first year, and then thereafter can go into longer term investments. If there are insurable losses, the money is there to pay the claims. If not, the money comes out as dividends and is subject to long-term capital gains rates, which can be a whole 20% less than your ordinary tax rates right now. One of my dental clients has been funding his captive for the past 10 years, covering risks as they came about. All the excess money he's just left in there, which will be able to be taken out in long-term capital gains at the time the business is shut down or as he needs it. One of the things you want to do with your captive insurance company is make sure it's set up right. You don't want to be taking too much deductions because, as we know, little pigs are cute and big hogs get slaughtered. So you want to make sure it's done right. This is why I use strategic risk alternatives. I studied a lot of captive insurance administrators. One of my dental clients has been funding his captive for the past 10 years, covering risk that had not been covered previously. When his business was shut down from the effects of COVID-19, he was able to make a claim on his insurance company and lessen the burden of the shutdown. Captive insurance companies are set up to insure risk, as we talked about. You take a part of your gross income, pay it out to your captive insurance company, and you're taking an insurance deduction at the time you do this. You want to have the risk reviewed that you have in the business that are not being covered right now. Then with this, you decide how much of that you want to cover, and you get to take a deduction for that amount that goes out of the captive. That money is then available to pay any claims or gets a reduction in taxes when you pull it out as dividends. There are many other tax planning ideas that come about based on the questions that I ask clients when I meet with them. We've set up 401ks, HSAs, cafeteria plans. We've set up much bigger defined benefit plans, all allowing them to take and defer taxes or eliminate them depending on what their goals are and what their needs are that we see in the future. Just because you can save taxes by spending money is usually not the best idea. I've had clients that are so tax adverse that they spend money just to pay less taxes. I've also had clients that are so tax adverse that they actually refuse to make money to avoid paying taxes. That seems a little strange to me. The problem with these tax avoidance strategies is it's counterproductive to building wealth and putting yourself in the best financial position possible. Say you go out and buy that new truck or SUV because it was good for your taxes. This takes money out of play to put you in the best financial position possible, and that truck or SUV will be worth less in just a few years. My best clients use determined practice to set themselves up for whatever life throws at them, and no matter what, are ready for what comes along. Now we will spend some time on the most commonly asked questions that I get. One of the questions that I often get asked is whether or not to pay off a mortgage. This to me is a philosophical question that the brightest minds have likely debated for centuries. Yes, it is true that interest rates are extremely low, and true that you can deduct the interest off of the first $750,000 of mortgage interest. Yet it is also true that it feels really great to pay off your home and not be beholden to a mortgage. Albert Einstein said that compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. If you are holding a mortgage for tax reasons only, then it is better to pay it off. Let's say that you have a $40,000 mortgage and get a $20,000 deduction for the interest that you paid, and you are in the 45% tax bracket between federal and state. If you pay the mortgage, your net out-of-pocket is $40,000 less your tax savings of $8,600, which equals a total of $31,400 paid. Now, if you do not have a mortgage, your net savings is $40,000 minus the taxes that you paid of $8,600, so your net increase in wealth is $31,400. In this scenario, you are financially better off by not having a mortgage. Now, the other side of this is if you have a better investment that will pay better than the interest cost of the mortgage. If the mortgage interest is at a 5% rate, and after taxes it costs 3.25%, assuming you are in the same 45% bracket. If you can get an after-tax rate of return on the investment better than 3.25%, then you would go ahead and do it. You would need to get better than a 5% return on your investment to be in a better financial position. When my wife and I had the opportunity to pay off our home, or not, we were split in the decision. As normal, she won and we paid off the home. I have to admit that it does feel good not to have the mortgage debt on our home. Another common question is, should I buy or lease a vehicle? Buying versus leasing is a financing question, and it really depends on what interest rate it is costing on the purchase and what it is costing on the lease. Lease interest rates are typically not published, so you have to dig or use an amortization schedule to figure it out. The real answer for when it comes to purchasing a vehicle as to what puts you in the best financial position is to buy a 3 or 4-year-old vehicle and drive it into the ground. Financially, this will typically yield the most amount of money left in your pocket. More complicated questions are when and how to sell a business and how to do it in the most tax-advantaged way possible. Typically, if you own your own business, you have a strong attachment to it, and the decision to sell is never really easy. When I sold my CPA practice, I thought it would be freeing and I would feel elated. What I felt instead was anxious and worried. This new territory took a little bit of thought and outside perspective to get through. I have a client going through it right now, and luckily since I've been through a couple of transitions, I can work him through it. If you have had a decent cash flow and you all of a sudden shut that off, then the worry is that you will have enough to get by. What you need here is a great financial planner to help make sure that you are transitioning at the right time. What you do not want to do is run out of money sooner than expected. I have had clients that have wasted away pensions, business earnings, and life savings on bad investments, and had to go back to work or live on a lot less than they could have had they not lost their hard-earned money. Now that some time has passed and I have figured out what I want to focus on for the next 10 to 15 years, the worry is gone and I am having fun with my situation of concentrating on my own businesses and working on them more than working in them. Where I live, a common asked question is, how much should I pay in tithing? That is an interesting question that I feel should be between you and your clergy, or you and the higher power that you worship. But since it is tax deductible, I still get the question. Another common question that I get every year is about land easements. A land easement is done by donating development rights to a conservation entity to remove the ability to develop the property in perpetuity. This is one of those areas where we will have to wait and see. The intent of Congress on both sides of the aisle was to allow conservation easements to set aside property so that it would not ever be developed. Personally, I like the idea and think it should be encouraged for both the conservation and the tax benefits. The problem is the IRS has decided to go against congressional intent, which is something they do every once in a while, and have given a safe harbor at a point that it really does not entice the easement to be done. Part of the issue is that it has become more mainstream because big investment groups are putting deals together and a lot more money is going into them. This is one of the areas that the courts will have to decide. If you are tempted to put money into a conservation easement, it is my advice to take all of the savings that you would have made and put it away in case an audit and adjustment happens. Audits on these programs are nearing the 100% range. Another question that is commonly asked is, when is my tax payment due? I always find this interesting since it has not changed in my lifetime. This usually comes around the time an extension needs to be filed. Taxes are due at the original due date of the return, unless there was a liability of more than $1,000 in the prior year. If there is a liability of more than the $1,000, then taxes are due quarterly throughout the year. If tax payments are not paid when they are due, there is a consequence of interest and penalties on the unpaid balance. The interest and penalties are calculated from the time the payments were due. One of my favorite questions is, I have an easy 1031 exchange question. In my experience, there is no such thing as an easy 1031 exchange question, and this question always makes me laugh. 1031 exchanges are tax-free exchanges of real property or other property that has been defined as real property, such as long enough termed leases, etc. To do a 1031 exchange, you cannot take possession of the money in the sale of the property. In fact, the money that is received is considered boot and is taxed in that year. Boot, by definition, is cash taken out or a reduction of debt on the received property over the debt of the property you gave up. And no, this is not all. Now say that you have gotten to this point and actually sold the property and had the proceeds placed with a qualified intermediary. Then you have 45 days to identify up to 3 properties and a total of 180 days to make the exchange into one of the properties identified. Now, along with this, there are a myriad of other do's and do-nots and can-nots. So the next time you have an easy 1031 question, know that it might get a laugh out of someone. Some inquisitive taxpayers might ask me, what are some deductions and credits that I can claim? The deductions and credits you're eligible to claim vary depending upon your situation. Here are some deductions that you can claim even if you don't itemize. Contributions to individual retirement accounts, including IRAs, SEP IRAs, simple IRAs, and solo 401ks. These phase out at higher incomes. 50% of self-employment taxes, student loan interest up to $2,500, tuition and fees for higher education up to $4,000 if you fall within income limits, health savings account contributions made with personal funds, deductions you may be eligible to claim only if you itemize. $10,000 maximum for the aggregate of state and local taxes paid. Interest on up to $1 million of eligible home mortgage debt for loans taken out before December 15, 2017, and up to $750,000 of eligible home mortgage debt for loans taken out after that. A deduction for medical expenses, but only if they cost at least 7.5% of your income. A deduction for charitable contributions that don't exceed a set percentage of income. And finally, here are credits you may or may not be eligible to claim. The Earned Income Tax Credit provides a credit for lower income Americans. Hopefully none of you listening to this are in this category. The Child Tax Credit provides a credit of up to $2,000 per qualifying child for tax years 2018 to 2024. As much as $1,400 of this credit is refundable. Eligibility begins phasing out at $200,000 of income for single filers and $400,000 in income for married couples filing jointly. The Child and Dependent Care Tax Credit is valued at 20 to 35% of the costs of allowable care expenses. up to $3,000 expenses for the care of one qualifying person. A taxpayer caring for 2 or more dependents could claim a maximum credit of $6,000. The American Opportunity Tax Credit provides a maximum credit of $2,500 for qualifying educational expenses paid for eligible students. The credit is available only for tuition paid for the first 4 years of post-secondary education, and there are income limits. The Lifetime Learning Credit provides a maximum credit of $2,000 per year for post-secondary educational costs. There are also income limits, and the credit is worth only 20% of the qualifying expenses, up to $10,000 maximum. We have spent time on business entity structuring already, which is another highly asked question area. The more questions that a client asks, the better informed they are. I love good questions going both ways in the client-advisor relationship, but it is my belief that the advisor should take the initiative to ask more and better questions for the betterment of the clients. We've gone over some tax strategies today that have allowed my clients to be put in the best financial position possible. I told you that we were going to talk about some of the things that I've seen done wrong. I told you that we were going to talk about the most common errors that I've seen. So let's dive into that and the questions that have brought those about. One of the most common mistakes that I've seen is the wrong type of entity choice or no entity at all when starting your own business. I've had new clients come to me and say, my CPA is telling me that I owe too much in taxes. And I'll look at the way they were structured, and there's nothing that I can do about it in the past. But what we'll do, take a holistic approach, look at what they're doing, and put the right entities in place to pay the least amount of taxes possible. So as a general rule, we use sole proprietorships for almost nothing. They're good to pay children out of, as we talked about before, to help save some taxes there. But the risk that they bring on is unlimited liability. So if something goes wrong in your Schedule C business or in your sole proprietorship, all that risk can be transferred up to you as the owner. Typically advise LLCs to own building assets or appreciating assets. We love LLCs or limited liability companies to hold appreciating assets. Those assets can come in freely and go out freely without causing a tax consequence. This doesn't work the same way if you have assets like this placed in a corporation. LLCs owned by husbands and wives are also able to pay their children without any tax consequences to the child. The main problem with them is that they're not great for operating entities. 100% of the income is subject to self-employment tax. So sometimes a client will come where they set up an LLC to do their business, and they have too much income and they're getting charged too much in taxes. S corporations are pass-through entities like LLCs, but the S corporation allows the officer to pay a reasonable wage for the work that they're doing in the business. The income that is left over after this wage is paid can be paid out in distributions, saving a lot on taxes. The other thing that I like about S corporations is that they provide the liability protection that you're looking for so that your assets outside of the company can be protected. It used to be the case that we didn't recommend C corporations very often unless you were going to bring in a lot of investors. But with the reduction of taxes for C corporations down to 21% and the dividend taxes being where it is, sometimes it makes sense. If you're not a service business, so if you're building a company that does not rely on you for all of the income, sometimes it makes sense that in this day and age to set up a C corporation. Section 1202 of the code allows you to take some of the money at the sale of a C corporation business tax-free. Section 1202 of the code allows you to take founder's share sales after 5 years. If the C corporation doesn't lie on you or all of the business earnings and operations, then it can be used to save taxes if you hold the C corporation stock for over 5 years. Another common problem that I found, and I alluded to a little bit before, was that shiny object syndrome. When the salesperson comes and you want to have the best, it doesn't always translate to more income in your pocket. I was helping set up a new dental practice in the last couple of years, and there were options between types of equipment. And we looked at the equipment, and there was a significant difference in the amount of cost. And we got down to the bottom of it as to whether or not spending more money would actually help with more dental work being done. And in the end, the decision was, well, we'll save a little bit here and put in an extra chair, which does help the business grow and produce more. Just because the sales guy is offering you the latest and greatest doesn't mean you have to bite. Another common problem that I've found is taking on the wrong things at the detriment of others in your business. We often looked at this as stepping over dollars to pick up dimes. I've seen business owners try to take on bookkeeping for themselves as opposed to just going and spending a little extra time in their business where they can leverage their time to make a lot more money than the cost of outsourcing. I've seen them take on payroll, bookkeeping, or worse yet, force their spouse to do the bookkeeping and think that that's going to work out good. The problems alone that can come from doing one's own payroll and the penalties that exist for missing a payment can be so high that you could have paid for the outsourced service from the beginning of the year. One of the things that we have to do is examine all of the areas where we can be most productive and push off those areas that are not our expertise. We want to set good management principles in place so that we can review what's going on and understand it, but we don't have to be the ones doing the work. One of the areas that I talk about a lot with one of my business managers is the problem with not being humble enough to learn. When we think we know, we don't allow ourselves to be set up to learn, and we typically cannot progress. The moment that we are humble enough to say that we may not know it all is the moment that we can start opening our minds to learn more. As a professional in your field, we know that you're smart. You are at the top of your class, or you wouldn't have gotten to where you are today. One of the areas that I find be most problematic in business is thinking that we know everything and not having the humility to realize that we don't. I often watch this in my teenagers who know everything and are rarely in the position to listen to me to learn. In fact, as I go on in life, I often say, the more I know I don't know. This is one of the reasons why I love consultants. The right consultant for the right situation can come in and with a different view, look at your business and help evaluate those things that are going wrong or those things that you can do better. For example, one of my clients had leveled off in their earnings and they could not figure out why that was. The one thing I know about business is we grow to our ability to manage. So in analyzing what was going on in their business, I found the right consultant, plugged them in, and they were able to take off again. So apart from outsourcing, another area that can be looked at is hiring a consultant. A lot of times we think in our heads consultants are way too expensive and I'm never going to get out of them what it is that I need. But what I found is completely the opposite. Every time I've hired a consultant, business has grown. Another big problem I find when it comes to business is that we don't always know what we don't know. And sometimes that problem comes in not having the humility to learn more or to ask. We talked a little bit about consultants and what they can do or did do, but I want to dive a little bit deeper into it. Every time I've hired a consultant, I've been happy with the results. Every time I found a consultant to come in and help a client out, I've been happy with the results. Knowing that you don't always know and hiring a consultant in allows you to let somebody come in with a different set of eyes to help look at your business and to help you solve the problems that can be found. Hiring a consultant in and bringing somebody in with outside eyes can often help you find problems that you didn't even know existed. And solving these problems can help take you to a new level. We all grow to our ability to manage. And I've been able to use consultants to help increase the ability to manage to help jumpstart or kickstart the growth again. One of my businesses erupted last year. We were facing too many growing pains. We were doing such great business that all of the processes broke within, and we had to stop the sales. And the worst thing I hate is stopping sales. So, we had to retrace our steps, bring in some outside help to teach us how to view things, set up a bunch of new systems in place, and fix the internal things, and now we're back up and running again and doing better than ever. In sitting down with clients and asking them questions, it's clear to me that some people don't know how to set goals. And if they do know how to set goals, they don't know how to set them in a way that they accomplish them. Figuring out how to set goals and then work towards accomplishing them is a way to take your business to a new level. So the underlying principle behind setting goals is what you focus on increases, or what you focus on comes about. Or another way of putting it is you get what you focus on. So when you set goals, you get to figure out what you want to focus on, and then you get to focus on what you want. One of my favorite ways of setting goals is under what's called the SMART goal format, which is making sure you're following a process or a system to help you accomplish your goals. We've been able to take clients who didn't set goals and move them into this simple process of setting goals and completely change their business and their lives. In fact, Thomas Gilbert said, "Mistakes in decisions about goals are the greatest single cause of human incompetence." We had a dentist who came to us who wanted to shut down their business, or wanted to sell their business. And they were taking home about $75,000 a year and working very hard to do it. We went in and put in some new systems and metrics for them to follow. And 6 months later, they were taking home $150,000 and working less to do it. Another area that we find that causes problems, one of the other areas that we often find is not knowing what levers to pull and what changes to make to allow your business to grow better. A lot of times clients come in and you ask them, how's their income? And they typically know. And here's the two things that they oftentimes focus on: income and how much they take out. And they don't know what their operating expenses are. They don't know what their gross margin is. They don't know how much they're spending in cost of goods sold. If we can plug in the right information and make it useful to our clients, we can get great results. In order to put into perspective today what we have talked about, I want to talk to you about the journey of my own business and what was spun out of it. I am sure that you will see and be able to use my experiences to understand where you are at in your journey and what might be next steps in improving your practice and changing your life. In August of 2004, after passing the CPA exam and quitting working for the CPA practice where I was, I teamed up with Weston Lunsford to start a CPA firm where we could put into place the ideas I had formulated about working with businesses and their owners and putting them in the best financial position possible. Almost all of the clients that I had worked for at the prior CPA firm followed me to our new venture. We had a couple of clients in a city 2 hours away from where we lived, and they were providing us more referrals every day. So with a small base of clients, a good referral source, and the willingness to work, we moved our young families and started a new journey. Running our own practice was a lot of work, and even though we had technical skills and the ability to sell what we had to offer, at this point in time, we did not have all the knowledge needed to handle the other 93% of what it takes to run our CPA practice. Yes, we had the education and a foundation of information, but we're lacking the knowledge on how to implement all of the parts needed to run a successful business. There were a few principles that made our business a success. First, we had a vision of where we wanted to take the firm, how much we wanted to make, and what we wanted our lives to look like down the road. We built a business plan, set our goals, and worked very hard to accomplish our dreams. It is interesting to look back at the business plan and financial model that we put together. Basically, everything that we put in our 10-year plan came to fruition. We had the revenue coming in, the number of employees that we had dreamed of, and were helping to change the lives of the business owners that we were working with. Next was the willingness to work. From working on farms and ranches in our youth to working tax season that required 80+ hours of work each week, the willingness to do what it takes to make the business successful was the foundation to building our practice. We knew how to roll up our sleeves and get to work. Work can solve a lot of problems. Another principle that drove our business was an insatiable appetite to learn and improve. We spent our off time reading management books and looking for ways to improve processes. We grew our firm at a very fast pace, doubling business every year for the first several years. We also, along the way, had a desire to do more and started some other entrepreneurial ventures. Now it was 2008 and the economy turned. We were heavily tied to the real estate market. Having spent my early career in real estate taxation, we found that it was time to get flexible and change. At this point, we decided to hire our own consultant and focused on growing the business again. With help from the consultant, we fine-tuned our sales and our product offerings and really started to focus on offering more help to our clients in defining and reaching their goals. We became laser-focused on changing our CPA practice to proactively working with our clients to put them in the best financial position possible. We met with our clients more often and brought them ideas on how to improve their businesses, pay less in taxes, and be able to reach their goals and dreams. In the next 3 years, we doubled again what we were producing annually. Now, all of our growth came from internal promotion. We never advertised nor spent money on marketing. We built relationships with our clients, and they were our greatest fans, referring us to all the people they knew. We definitely felt blessed that this was the case. Fast forward to 2011, and along with doubling our practice, we built another labor supply business that was growing quickly. We had added another partner to the labor supply company, and we all decided to sell that business and grow in a different direction. By 2011, we were working extensively with dental professionals, and with selling that business, we decided it was time to focus more on these dental professionals. We love dentists for lots of reasons. They are very smart people. In fact, they have to be to even get into dental school. All of the dentists that we worked with were smart and yet still humble enough to take the ideas that we brought them and put them into practice, allowing for monumental changes in their lives. What we also saw is that they were typically not great when it comes to the financial aspects of their business. We saw that the typical dentist would look only at a couple of numbers in their practice. These numbers were gross collections and monthly distributions. Now, I am not saying that all of them were this way, but we were finding enough of it to know that we could put together some metrics and processes to help improve their practices and lives. In working with dentists, we initially started having our CPA managers look into the numbers and find ways to improve the dentist's financial position. What we soon found was the personality and training that they had was not what was needed to help the clients along. From my experience, only about 5% of CPAs ever look beyond the work that is in front of them. They are great technicians and bright people, but when it comes to getting great results, as the book Good to Great teaches, we had to get the right people, and in our case personalities and dispositions, on the bus, and make sure they were seated in the right seats. With the new hires hired and trained, we started developing the foundation of what would go on to become Dental Intelligence. From dentalintelligence.com we read, over a decade ago we were helping dental practices get better through a combination of our very early proprietary software and lots of one-on-one consulting and training. Even back then, our rudimentary software made sense of all the data hidden inside the practice management software. It tracked everything and gave practices an eye-opening, 100% transparent look at what was really going on. Suddenly, practices had real-time data that they could use to make decisions. We got rid of guesswork, and dentists and office managers really loved it. Thousands of hours of development later, years of perfecting, and today our inboxes are filled daily with messages from doctors, office managers, dental hygienists, and front office team members who are blown away by the results they are experiencing with this insanely intelligent software. We look forward to getting an email like that from you sometime soon. We were building success cases by hand. We created spreadsheets and started digging into what drives a dental practice. The deeper we dove, the more we understood that the dental practice management software had the data, but did not present it in such a way that was useful in changing the lives of the practice owners. By 2013, we spun Dental Intelligence out of the CPA practice, and Weston Lunsford and our other partner, Rob Bay, went on to build a company that provides the most useful software for making life-changing movement in the lives of the people it touches. There are over 8,000 dental practices using the software today. I want to share with you some of the recent stories of the lives of the people we have recently been able to change. I signed up Boston Dental yesterday and received an email from Ariana, the office manager, this morning to give her a call at my earliest convenience. I called her on my way to work, and she shared with me that in just 2 hours this morning, they have already collected 62 payments for a total of $16,000. By the time we got to the end of our call, they had another 2 payments made, putting them over $17,000. 5 minutes later, when I got into the office and went to their account to capture the screenshot to share with everyone, they had another payment made for a total of 65 payments and $17,731 collected in their first 2 hours of using it. Oh, by the way, Ariana's doctor was skeptical, and she had to beg him to use Dental Intelligence in the first place. I've been looking up a practice this morning who signed up back in December and has been training with Ashley. They started in December with a pre-appointment of 69% of hygiene and reappointment at 85%. In the last few months, they've increased their hygiene reappointment to 93% and have focused on the back door. Their pre-appointment is currently 81%, and their future visits has increased from 1,921 to 2,372. Their active patient base has stuck around the $2,600 mark without any significant changes. To say it short, focusing on your patient base and taking control of their business is resulting in an additional greater than 400 visits. Here is another one. Good afternoon. I recently interviewed Alicia, the office manager at Q Dental, about how Dental Intel has impacted their practice. Alicia is a super fan. I loved what she shared below about how we helped them after the shutdown and wanted to share with everyone. We are really changing lives. When we came back from being shut down during the pandemic, we had the same questions everyone else had. When should we come back? Where do we start? It was so easy to open Dental Intel and see the people we needed to immediately contact, or to quickly see that treatment plans needed follow-up, or who had missed hygiene appointments. We didn't have a single patient fall through the cracks during the pandemic. Having Dental Intel was like having a full-time employee who worked during the entire shutdown and had everything ready for us. When we opened the doors again, all the info we needed was right there. Easy to understand and immediately actionable. Dental intelligence is now the core of our practice. This software allowed us to make our vision come about on a much greater reach. I stayed back at the CPA firm to make the transition possible, and within a couple of years had a successful exit of both businesses. Because of my love of helping others, I continue to consult on the strategies we talked about today, whether it be tax, business improvement, looking into what dental intelligence can do for dental practices, or analyzing and advising on setting up captive insurance companies and warranty programs. Finding my purpose in life of helping businesses grow, putting clients in the best financial position possible, and creating opportunities for growth in others is still what drives me today. I like to be challenged, and that has shown up in the businesses that I have purchased and founded and continue learning how to make them better each day. So when you're finished with the big accomplishment of taking on the Grand Canyon, setting yourself up for retirement, or building the model practice that you want, the thrill of the accomplishment can take you to new heights that you've never been before. By working with the right advisors, those who take the time to ask the right questions and plug the right people in place, you can understand how to manage your business and turn it into the type of business that you've always dreamed of. With the right preparation, questions, and people in your life, you can obtain your goals and live the adventure of life at its fullest.
Thank you, Shaylin. I have some questions, but before I get to those, I'd like to again invite viewers to use the question box in your control panel to ask any questions that you have. My first question is, what size of dental practice would the self-insuring work for?
That's a great question, Mally. What I usually tell my clients is that it's not the size of the practice, but how much free cash flow that they have. And typically what I find is the self-insurance company will allow you to put away about 10 to 15% of your gross into premiums for the insurance company. This is a safe haven area, keeping you safe from questions from the IRS. But typically you need about $100,000 of free cash flow to be able to make this work for you.
Okay, second question, which of these solutions work for a dentist looking to sell their practice or retire within the next 5 to 7 years?
I would say all of these work if they're looking to retire in the next 5 to 7 years. Putting away money in a captive insurance company and reducing it from ordinary income to dividend rates is great. Looking at downsizing your home where you can take money off the table on a tax-free basis is another thing that happens often. Setting up your 401k plan. There are many of these things that work in that. Harvesting losses and getting ready for the sale. I can just think all of these can help.
Have there been rumors? There have been rumors of tax rate increases, including capital gains. How likely is that to come to fruition?
In my mind, I think it's 100% likely. With what we've done in our government and in our economy, I think that we're going to see higher tax rates. What we do is we plan for the best thing today, always, with the information that we have. And typically when they change a tax law, what they do is they give us the time in that year to make it come about. They typically don't go retroactive with a tax law.
Can you give me an example of why I might want to self-insure?
Self-insurance works great. We first started a captive insurance company with one of my businesses back in 2007. And businesses went really well for 2007 till 2011. And then there were some government regulations that came in, just as the dental practices that got shut down in COVID this year. We were running as dental professionals, and then somebody came and told us that we couldn't practice for a time. And in some states, that was a lot longer than others. Well, having that insurance money available was one way of getting through that time. For us, it was government regulations came in and changed. They passed some laws, and we were just glad that we had the money there for the downturn.
Okay, which one of these tips that you were discussing do you think is the most beneficial to do?
The most beneficial, that's a great question. It really depends on your situation. And so what I find is that it's typically best to sit down for 30 minutes or so, figure out what your goals are, and figure out what the strategy is that needs to be put in place for you.
Our final question is, what does a specialized CPA firm provide that my general CPA does not?
Most CPA firms are too busy today to take care of their clients. They do what's called the fast food approach. They sit at the drive-up window and they wait for you to bring them what your needs are, and then they serve it up and they brag about the billions served. A specialized firm will typically look for ideas that they can bring to you to put you in the best financial position possible. And it is a big difference.
Well, that's about all the time we have today. Thank you everyone for your questions. But if we do not get to your question, we will answer it after the webinar via email. Please be sure to take the free CE quiz associated with this webinar. Shortly, we will send you a recording of this presentation and instructions on how to access the CE quiz. Thank you all again for attending, and a special thank you to Shaylin Peck and our sponsor for this webinar, Strategic Risk Alternatives. Thank you and have a great day.